So in this video, we're talking about bull call calendar spread. There are various names for this. Some people refer to it as a horizontal spread or time spread. It really is a simple vertical call spread, except your long call position has a longer maturity. So let's talk about it. So with a with a bull call calendar spread, you have a long call with a longer maturity and a short call with a shorter maturity. So this is your typical debit spread where you are actually paying to construct this strategy. You're buying a long call and you just want to have a longer maturity, and this is expensive. So the idea is that by writing a call against this long position, you're trying to make the spread cheaper. The main difference between the calendar spread and our usual vertical spread is that with this calendar spread, your long call has a longer maturity. So let's draw this on our usual technical analysis website, TradingView. So notice that I have it on a daily, and this is the S&P 500 index, the SPX, and this is the April the 20th. Today is the 19th, Sunday, and Monday we're going to open up on the 20th. This is the 27th, and this is the May the 1st. So this is the first Friday coming up, and this is the second Friday coming up. So this is a bull call spread. So we have a bullish expectation that the market is going to go up. Just for the sake of this argument, I'm going to draw our first line. For instance, let's say that we expect this to be, say, 29.40. So this is your 29.40 long position going all the way to May 1st. Right. So notice how this is your long call position where you have 2 weeks of a maturity. So let's just see if we can find the price for that one. $29.40 for May 1st. So let's look at options. And we are looking for May 1st. All right, and this is a call option. 29.40 right there. So 29.40 is last price is 41, bid is 42, and the ask is 43.10. So let's start our spreadsheet. We are buying a call option, although this is going to be a little more complicated than our usual vertical spread, simply because when one of the options expired, the other one's still going to be alive, so it will require to do a premium calculation, which you can find it in your lecture notes. So we're going to have a long call with a strike price of 29.40, and that's our main intent because we have a bullish expectation for the sake of this argument, for the sake of this lecture, and the price is 43.10. 43.10. Now, if we are buying one contract, then the cost will be this times 100, so $4,310. That's our cost. Now, this is too high. So what we are going to do is, by the way, the maturity for this one is May 1st, 2020. Right. So now we're going to write another one. Now, with our usual vertical spread, we would have actually write a short call against this with a different strike and then with a different price, and obviously try to make this one cheaper. Because this is a horizontal strike, the difference will be in the maturity and the strike prices will be the same. So 29.40, and let's look at a price for a shorter maturity. So instead of May 1st, we go with April the 27th for the same strike price, which, these are the puts. 29.40 has a 29.20. And then the cost will be this times 100, and that is 2,940. So the total then will be, since we are paying this and then we are collecting this, will be that we actually pay $1,390 for this specific horizontal calendar call spread. Now notice our cost went from $4,300 with a naked long call with a long maturity down to a $1,390 of a horizontal time spread or a calendar spread with calls. So if we were to draw this, the idea is that we have the same. So this one is actually, let's make it red. So we need a second one. And then the second one, we want it to be a different color. So let's make it blue. So notice, unfortunately, I have to make it the same, but this will be until April the 27th. So this is your April 27th. And I'm going to drag this all the way to the top on top of it. So, I mean, I just don't want to put it right on top, but this is what it is. You have it at the same strike price, and this red line is your long call position with a long maturity, simply because you want to take advantage of that 2 weeks period bull expectation, and you're hoping that the market is going to go up, and 2 weeks is a nice period of time to wait for that market to recover. But this is, too expensive, $4,300 to pay for it. So you want to make it cheaper. Now, one alternative is to make it cheaper with a vertical spread, but now you choose to do with a horizontal spread, a time spread or a calendar spread. And for that, we basically write a short call at the same strike price with a shorter maturity. And for the sake of this lecture, we just chose, first Friday and then the second Friday. And that simply is to make the long call cheaper. And this is the example of a bull call calendar spread. So that's about it. Please let me know if you have any questions. Thank you.